let's move on and get in Seshadri Sen, the head of research and strategist at Emkay Global. They made a trip to Delhi. So there have been a lot of takeaways and what's happening on the policy front as well. So let's get that conversation going. Seshadri, good morning. Thank you so much for joining in. Well, tell us more about this trip of yours. What was the on-ground situation? We've been talking about this consumption decline. There have been conversations in the circles. We are looking forward to an RBI policy as well. Do you think we will see some action on the back of the slowdown in consumption that we've been seeing?
Yeah, so our takeaways were in three sections. The first is that the first worry is that Capex has slowed down significantly in the first half. The general feeling in Delhi is that that was more idiosyncratic, based out on the elections and a very heavy monsoon, which has delayed the pickup in government capex. And we should see a slight acceleration in the second half now that things are settling down. The second one wrinkle there, though, is that given the hard limits on state borrowing, the recent pickup in welfare spending from the states will probably slow down state capex. So central government capex should pick up in the second half. The MK view is that it will probably miss the annual budget targets by a small bit. But second half should be much better than the first half in general. But on the state side, we should expect a slightly slower capex trajectory because of the pickup in welfare spending that we've seen over the last 2 years. On consumption, the corporate results has raised some worries, but there is no alarm in Delhi at the moment. The overall macro data is at worst mixed. Yes, there is a feeling that the RBI tightening has played a role, but given the complex geopolitical situation, the DXY rally, etc., I think the RBI will have to decide at its own pace when it is a good time to unwind its overall tight monetary policy stance. And they've already made a first step there, I may point out, by moving their liquidity stance to neutral. So those were the two broad takeaways as far as the domestic economy is concerned.
Absolutely. Those are the important takeaways on the domestic economy front. So one of the points first I want to pick out on is in terms of consumption. Q2 wasn't that exciting in terms of a trend there, but what are we expecting in terms of the second half? And is there something specifically that can be done to improve this consumption trend from the government front or the policy fronts that are coming
in? Not everything can be solved by government at short notice, right? So meaning consumption has slowed down. There is a base effect there. We all know that at the state government level, there is a considerable amount of welfare spending, which is a consumption stimulus by itself. Is there alarm in Delhi at the slowdown in this consumption? No. At the moment, the feeling is that it's probably a cyclical slowdown. It may not be as bad as the corporate results suggest. In due course, if the RBI starts to ease up a little bit, some of this will get solved by itself. That was the broad feeling that we came away with, but they're continuously watching it. Yes, if it does continue to slow down, then I think, there may be some intervention needed sometime in calendar year 25. Having said that, our view is that this will be a slightly prolonged consumption slowdown. There are multiple factors. There's a base effect. There is the impact of what was a very poor white-collar job market in the second half of FY24. That's having a delayed impact. Longer term, we are not worried at all about consumption. This is MK's view. As India moves up the per capita income charts, there will be a continued exponential growth in many categories in consumption. But yeah, we may have to live with a quarter or two of a slowdown and wait for us to see how that evolves. The white-collar job market itself, especially if the IT sector recovers, is showing signs of improvement. So that will solve part of the problem as well.
Okay. So the white collar job part of things are improving, or at least the consumption story will continue, according to you, Seshadri. There's a lot happening in the geopolitical arena as well. We have a new president coming in the US. How do you see that thing changing things for India? Do you think still the focal point will continue to be India for global investors, for consumption patterns as well?
Yeah, so that was also part of our discussions. We spoke to two or three geopolitical experts while there. At a first order level, India is not worried at all. The India US strategic relationship has survived multiple precedents. And, Trump, if anything, has been a good partner for India in the past. So there are no immediate worries. A tariff would, of course, hurt India, but it would hurt all of India's competitors equally. India is not being singled out. So that is not incrementally that much of bad news as far as India is concerned. There is, however, a short-term second-order problem that India may have to deal with. If US and China do enter into a tariff or a trade war, right? US imposes tariffs, China depreciates the currency, then that instability, especially with global dollar strength, could have an impact on India's flows and India's external account. And that is something India have to deal with. Our view is that if it happens, it will be strictly short term. It will be a two to at worst 3-quarter phenomenon. And we are in a period where India's current account deficit and forex reserves are at all-time, strong positions. So it's not something that's going to majorly destabilize India or even the Indian markets for an extended period. But that would be the key second-order geopolitical risk that a US-China trade war could bring in.
Sure. And Mr. Sen, just the last word in terms of the political scenario in India, right? General elections is over. Tomorrow we have Maharashtra's election results. And next year we're watching out for UP Assembly elections. So that state elections, those keep continuing. Anything that we have to worry on that front or anything that one should be watching out for over there?
At the moment, no. I think the big event is over, which was the Lok Sabha elections. There was a bit of a setback for the NDA, and they've seemed to have taken it in their stride at the moment. But the key factor we are watching out for is that does that mean that the government pivots from Capex-led state, federal spending to a little more bias towards revenue expenditure and welfare? The final budget of FY25 did not seem to reflect that, and we don't think that that is the case. Yes, at the state level, and we've written on this, there is a pivot towards welfare spending that started actually before the Lok Sabha elections of 2024, and that is continuing, and that we saw in a slightly exaggerated manner in Maharashtra. So our take is that whatever one had to, whatever the impact of politics and political developments have already been absorbed. FY20, we have Bihar and UP coming up over the next 2 years. But I no signs at all, at least from what we see and from our conversations with some experts in Delhi, that there is a pivot away from the overall economic thinking or the economic policy of the government, which is based on higher capex, focus on macro financial stability, and a sharp focus on inflation. None of these seem to be changing at the moment. So we don't think that politics is a major worry over the next 12 to 15 months.
Okay. All right, take that point, Seshadri. So consumption, that was the big worry, but it seems that is not something that the government is worried about. So we'll have to watch out for the outlook on that one. Thank you so much for joining today with your insights and the takeaways from this policy trip. Time for a short break now. Saurabh Agrawal from EVA India and Sabyasachi Majumdar from Care Ratings will join in on the other side to discuss the impact of China slashing export duty rebate on many key components, including solar panels, solar modules, etc.